I'm John Hanna for CityTV.net here in New York City, and we have Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good afternoon, Greg.
Good afternoon, John.
How are you doing today, sir?
Well, we're doing well. Enjoying the spring weather, and my allergies are reflecting that.
Hey.
Spring, come the good allergies down here in Oklahoma. So yeah, we spring is just right around the corner. I mean, here we are March 19th, and here we are, and things are blooming like crazy, and the markets are doing the same thing. I mean, between relatively calm over Greece and then, the Fed saying they're going to stand pat on their interest rates and a little bit of easing on the oil front, last week investors really felt comfortable in fleeing the low yields of U.S. Treasuries. So what we're seeing is yields soaring, particularly on the shorter end of the spectrum, and bond prices falling. The benchmark 10-year hit a level not seen since last August. The yield closed at 1.89 in 2011, and as of the 16th, it was 2.31. So that's a significant increase, 27 basis points actually. Actually, year to date, it's 42 basis points. For the week, it changed 27 basis points. So the S&P had its best week of the year and closed above 1,400 for the first time since May of '08, and the Dow recaptured 13,000 and tied its 2012 weekly record. Year to date, the Dow's up 8.31, S&P up 11.7%. And so really just no news is good news from the Federal Reserve. Continue to stay the course on interest rates and Operation Twist bond repurchase program. We had spiking gas prices. It hit consumer inflation in February. If you take out food and energy, and costs were only up about 0.1% for February. So dramatically reduced exports helped create China's largest monthly trade deficit in 2 decades, according to China's General Administration of Customs. A 40% increase in imports helped push February's trade deficit to $31.5 billion. Through China's Lunar Year holiday in January. The Federal Reserve, as I mentioned, John, kept interest rates still. With their stance on interest rates, keeping it low for the foreseeable future. So that's pretty bullish. To keep the economy stimulated. Also, we had the Philadelphia and New York region showed continued expansion at a moderate pace. And the Commerce Department said a manufacturing slowdown and lower natural gas extraction kept U.S. industrial production relatively unchanged. So this week, John, we're looking, conditions I think are in place for Greece to make its bond payments on Tuesday. We have some domestic housing data that could suggest whether we had a relatively benign housing stats for the recent months were produced by mild weather or the beginning of a genuine recovery. And some of those key date releases are the housing starts and Greek bond payments on Tuesday, home resales on the 21st, new home sales, and weekly job claims on the 23rd. And as I mentioned the last couple of weeks, John, the markets continue just to kind of edge higher, and we've kind of paused here recently as the Dow has hit that 13,000 level. But volatility is at several-year lows. So we're continue to have a lot of volatility, reduction of volatility as far as complacency in the market. Fear is moving out. And, this may continue for a while. But at some point, we do need a pullback. At 5 to 10% range would be healthy. And also we look at, I mentioned interest rates at the beginning of our talk. So John, what we've seen in interest rates over the last 5 years, they're hitting their lows back where we had in 2008, and are just now starting within the last week or so to come up off that trading range. So we're at historically low rates on the 30-year, for example, and even on the 10-year. And what we're seeing is bond prices that have peaked out. And it looks like so when bond prices, when interest rates go up, bond prices come down. Now we saw that happen. We saw interest rates drop significantly during the 2008 financial crisis because people fled to bonds, specifically the U.S. Treasury. And so bond prices, interest rates dropped, bond prices escalated. Well, we're at the top range of that bond prices that were in 2008, meaning it looks like they're starting to peak. So what this means is that we could see interest rates continue to move higher as market conditions, people get out of bonds and move into equities and other more risk assets. And so we could see interest rates continue to climb higher on the 30-year and the 10-year and so on. So this bodes well for probably the markets for the foreseeable future. And of course, at some point, if interest rates climb high enough, people will start moving back into bonds to get a higher rate of return. So right now, it looks like the season could be ripe for a continued uptrend. Of course, barring any kind of negative news or surprises in our world economy.
All right, there you go. That's Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma. And I'm John Hanna for citytv.net in New York City.